Hello, today I'm going to be taking a look at the Ftse 250, plus having a look at the macro situation. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a professional financial advisor before making any investment decision. So to start with, I like to zoom out and look at the larger time scale going back to 1985. And we can see a trend that the Ftse 250 does always go up in time. And traditionally, we used to have these boom and busts with the classic Black Monday, dot-com bubble, and then credit crisis bubble events. But it did seem to follow this gradient overall. And then, interestingly, ever since the credit crisis in 2008, the gradient does steepen of this increase. But then also, the volatility around it seems to reduce. It's almost like there's an end to the boom and bust cycles. And when I look at the macro here, we see how when there was the financial crisis, they reduced interest rates to practically zero and started all this money printing. And this form of economics, I'm labeling as New Keynesian economics, and more on that later. But still, we definitely did see that trend until, of course, the governments made all sorts of terrible decisions when we had the corona crisis. And the UK government ended up pumping an extra zero point 0.4 trillion of quantitative easing or helicopter money into the economy, which then did pump up the Ftse 250. But then ever since we started seeing the inflation problems in 2021 and then a subsequent increase in interest rates, we see that bubble pop, and we're definitely now a couple of years into a bear market. But now I'm trying to work out if we're actually already out that bear market or if this bear market could actually continue for longer. And there is certainly got to be some kind of link between the increase of interest rates because of inflation and the party being over in the Ftse 250. So back onto the new Keynesian economics model, and this is where the governments believe they can meet their central bank objectives of 2% inflation, GDP growth of about 2%, and unemployment below 5% by tweaking interest rates and doing money printing. Now, first of all, with inflation, and actually, I think the government would actually be happy with 4% inflation, even though their target's 2%, because that would help them inflate away their debt. But all the same, I've got it currently about 8%. It's actually 8% year on year at the moment. But in terms of CPI inflation, this tends to be quite variable month on month. So what I do is I package that into quarters, and based on the latest quarterly print, we are looking at about an 8%. But you see, the general trend is a reduction, which some people have been getting excited about. But we're still very high, and even if that trend continues, we're still looking at a good year or so before we're at the that 2% target. With what we see here on the bottom left of the chart being what actually you should have in a normally functioning economy. So it's an absolute disaster, really, in terms of inflation. This here shows the Office for Budget Responsibility's prediction for what inflation was going to be on year terms. And the last they kept on, and of course, laughably, they kept on revising it as the goal. They kept on changing the goalposts as the data got worse and worse. But this was their latest prediction, which I believe was in February 2022. But there they suggested it would be going down like this, but this is what actually happened. But it is actually now following that trend. But it looks like the best case, according to them, would be actually we would have to wait till 2025 or something at this slope before we got down to the 2%. Of course, the other alternative is if we go into a proper recession, that could then bring it down sharply, and then we could then take our medicine in a shorter span of time. So GDP growth is only 0.1% at the moment. That's based on the last quarter of the data we have. And you can see in the first quarter overall it was only 0.1%. So this is clear stagnation in terms of GDP. It's not a technical recession yet, but clear stagnation. And eyeballing this, is we are clearly in a situation of stagflation with, and you do wonder if it's going to actually be a recession as well coming up in the next few quarters. Actually, I think that GDP growth there needs to be read. So unemployment is actually, that's a real bright spot. It's still only 4%. It is ticking up mine, but it's still very low at 4%. And house prices are strangely maintaining themselves, although there's a lot of talk and drama about that. Looking at the data there, from year start, house prices are doing okay. But of course, house prices are known to be a lagging indicator. So normally you'd have like the recession first, then the house price crash next. So bear that in mind. So the main message here is a situation of stagflation and a danger of a proper recession coming up in the coming quarters. We've also got to bear in mind, though, there's various facets of the world which allow this new Keynesian economics game plan to actually exist. So one is the artificially strong pound sterling. The UK is only allowed to get away with this, whereas other countries like your Greece's or your Turkeys or wherever, they can't do this money printing and stuff without ruining their inflation and stuff, because we have the benefit of having a artificially strong pound sterling, because it does actually represent 5% of the world's foreign currency reserves. But then, of course, a currency crisis in the UK would send the whole stack of cards collapsing down. So I like to keep an eye on the yield curves. And of course, last time I had a look at them, actually, they were only partially inverted. Since then, they've now flipped to being fully inverted with a implied probability of default of about 0.5%, which actually seems quite high for a country like the UK. So although the sky isn't falling on our head yet, we certainly have to factor in that there is a risk, and that there is an enhanced risk of a currency problem with the UK based on the yield curves. Another thing is, people always say that inverted yield curves are a harbinger of a recession coming up as well. Another thing is the Japanese yield curve. Now, this is what a yield curve is supposed to look like, but in Japan, they continue to spend loads of money artificially propping up their yield curve, and then the US and other countries then depend on them doing that in order for them to get away with what they're getting away with. And I think the Japanese do that to artificially keep their currency weak, so that they can, because they rely on exports a lot. But still, if that broke, and there has actually been some tweaking of the rules around which they prop up their yield curve recently. So if though that was to break, then that could then have a knock-on effect to the rest of the world, including the UK. But particularly, I think the US and the UK would be affected. So again, that's another thing that needs to be on the radar. It's the world isn't ending, but it is like a risk that exists that we need to factor in. So in terms of government debt and fiscal deficit, obviously, because we're regarded as a safer, in the long term, a country with the assets and the people and the history and the robustness, people can feel that our currency is kind of safe in that regard, and which is why we can get away with the all of the loose policy. Um, but a lot of that is down to government debt, and fiscal deficit plays a part. But the government debt is okay at 101% of GDP, which isn't that bad historically speaking. But something that is happening is that the because of the interest rates have gone up, that means that we now have to spend money. We have to spend a lot more on just paying off the interest on the debt, which wasn't the case when we had zero interest rates. And so, although it's kind of okay now, there is a risk that it could start becoming unsustainable. So, again, that's something that's a new risk, really, that wasn't there. And we're currently got a fiscal deficit of 8% of our GDP, which is, fairly nasty. And again, we need to keep an eye on that not getting out of control, but it's probably okay at the moment. And then here, another thing that's allowed this new Keynesian economics blueprint to survive and to be pervasive is there's been these deflationary forces. So particularly the growth of the internet, technology, globalization. Those then balance off the inflationary forces of the artificially loose fiscal spending and central bank policy. As you can see, we've increased interest rates, so that's helped buff down the forces. But there is actually now energy crisis and food inflation that are starting to rear their heads again. So I'll put them onto one burner each. So overall, this is okay. There's all kinds of moving parts here that you've got to then realise, which could then send things in the wrong direction, like they did after the COVID period when we had a energy crisis and supply chain crisis. It unbalanced things to then create inflation. An interesting little footnote is it is interesting to think that perhaps AI could become a massive deflationary force in the future, which could then lead to NK on steroids and even the transition into perhaps some would say the sick socialist fantasy of modern monetary theory, or it could perhaps be the transcendence of civilization, to the next level. But there's no way I could know which of those is the case. I don't think there's many people who could possibly know which of those is the truth of the matter. But still, AI could be a severe deflationary force, which could then give the world governments a lot of latitude to start experimenting with capitalism, really. However, I don't think that's going to happen for quite a few years, but it's still definitely there. So currently, the FTSE 250 is possibly in a 2-year bear market, based on looking at the situation of inflation is still way too high, and then how GDP growth is stagnant. It's clear to me that we're in a stagflation situation, and with inflation where it is, and with inflation still way too high, even when you consider it at a quarterly basis, I really can't see the Bank of England pivoting anytime soon. And so for me, it's kind of a best case of a very unpleasant stagflation situation for, years really. And at worst, a recession, maybe late this year, maybe next year, but it does seem pointed that way. I look at it as being anywhere between these two arrows here going forward. But please remember, I'm just doing this for fun, and speak to your financial advisor before you start doing anything. So to conclude, we're 2 years into a bear market. It's not clear if we're already out of this bear market or if it could continue for years even. Based on inflation data and GDP growth, it looks like we're entering a stagflation period and probably a recession. So this becomes my base assumption. It's interesting to note, if you look at the last video I did, in the US, it actually looks like they're pulling off a soft landing. They've got 3% GDP growth the last 2 quarters, plus their inflation's coming down a lot better than us. Of course, remember that they've got the world reserve currency status, and because they allow fracking in the US, which we don't in the UK, they've actually got a bounty of hydrocarbon reserves, and they're now one of the world's leading hydrocarbon net exporters. So there's plenty of reasons why the US are in a better position for us, but unfortunately we don't have a lot of those luxuries. So this to me explains why the US are pulling off a soft landing whilst we are buying all the gas off them and are basically suffering a stagflation situation. And so I like to then consider what kind of percentage of my portfolio would I like to be in risky things. There's various things that could be considered not risk. So, you could have your money in different currencies, not just held in pound sterling. You could use bonds. You could, some people go into gold. But I don't like to go into the detail of what my composition is, but I do like to at least broadly think about what percentage of my portfolio I want to be in risk um, based on the macro situation. And I've had it set at 30%, and I've kind of decided to go to 40% actually. But mainly because I want less raw cash. Um, but the caveats are that that's going to be a target for end of year. So, and I want to be careful about how I increase that risk. It's got to be something that's going to do okay in a stagflationary situation. So one example of that is uranium, but I already hold some uranium. But uranium is something which is completely inflation proof. What determines the price of uranium is how many nuclear reactors there are and how many mines there are mining uranium, and that's something that's like a 10-year to 20-year kind of time scale it takes to build new reactors and stuff. So that's something which is kind of recession proof. However, now actually I wouldn't buy uranium now actually, because it's gone up a lot in recent years, but it's an example of something that's recession proof. So I'm looking for something that's recession proof and the right time to buy, but with a lot of caveats there that it's got to be stuff which I think can do okay in a stagflationary environment. So this completes my initial executive summary. But now, because some people like it, I'm going to go into a bit more detail with a few things. So first of all, the Ftse 100. What's interesting about the Ftse 100 is, unlike the Ftse 250, it doesn't seem to respond to the low interest rates. The gradient didn't change. But what you find is that the top 10 stocks in the Ftse 100 account for 46% of the total market cap, and they're all kind of conglomerate monopolies, and they're sectors which work off against each other. So in the this is all very approximate data, but roughly speaking, in the last quarter, um, the hydrocarbons and pharmaceuticals went down a lot, whereas banking commodities went up a lot. So you see they're they're just like a handful of companies which seem to work against each other, creating and it can only just be one or two companies in each case as well, working off against each other, and this creates a tone deaf index, and that's why the Ftse 100 is really useless as a kind of barometer to measure against when you're trying to make investment decisions. And that's why I don't understand why everyone focuses on the Ftse 100 when it's kind of no use to me when the typical stocks I'm owning are going to be Ftse 250 ones. Here's GDP against government debt, and you can see how all that money printing when we had the Corona crisis, and there was all the free money handouts and all kinds of things going on. It really was a bit of a clown show. You can see how GDP dropped and government debt increased, and so that got us to where government debt's now 100% of GDP, where it was falling short of it historically. But at least the government debt stayed at the similar level to GDP ever since. So the situation does look quite stable. But it's interesting to see the red line here of government debt. It started to tick up, and that I think's the effect of with the higher interest rates now. That adds to the government debt every year because we're now having to pay significant amounts of interest on that debt, whereas before it was practically free. So that's something to watch out on if this causes, certainly with the current fiscal indiscipline, if that starts to go out of control. Nominal GDP growth in green against CPI inflation. And we can see that in contrast with the US, and go back and look at that video I did on the US, in the UK, it took, after the COVID crisis, it took a while for the inflation to then respond to what was going on with the GDP growth. But then what's happened is we've entered this period of stagflation. This is just a clear stagflation trend going back to the beginning of last year, because we've got completely stagnant GDP growth and we've got quite a bit higher CPI inflation. And this here really does marry up, I think, with what I was saying before, where the kind of best case, according to the Bank of England plan, is we'd have basically quite bad stagflation, and it would take till, if these gradients were to continue, it would be not till 2025 until we'd see things kind of correct. But the other alternative being a proper recession, then giving us the bad medicine, and that could then fix things sooner. But either way, it's looking nasty. And here's the retail sales data. And we see that although the retail sales are going up, that's because everything's costing more because of inflation. And when you look at volume, the amount of stuff actually being sold is lower. So people are actually buying less, but it's costing them more money. And so again, stagflation. We've got interest rates, and we see that they're now up to around a 5% level, which historically isn't so bad. And we know that the bank's going to perhaps hold them now, increase them a bit more, but then hold them for quite some time. The inflation down here, you really do see here how bad inflation is at the moment. So that's why it's good to go and look at this detailed data, because I think it does back up my executive summary kind of main points. So house prices have stood up quite well. Like I said before, that tends to be perhaps a lagging thing though. Unemployment is really low, but yeah, so a couple of bright spots there. And here we see fiscal deficit, and maybe when I do my next video, I'll go into actually what proportion of that is the interest on the debt. But I suspect that that's starting to become a problem. And when we go back to the historically where it was before the government bad decisions in 2020, it's not looking good at all, and it's a bad trend. And here we've got the government debt as a percentage of GDP, and we can see at the moment we're somewhere between normality and a World War II situation, about halfway between. So that completes my update for the Ftse 250. and taking a look at the macro situation. And I'm generally definitely staying away from investing in Ftse 250 stocks whilst we see the data play out. Really, looking at the numbers, it does seem clear to me that we're in a stagflation situation with a high risk of a recession. So I hope you enjoyed that video. Good luck with whatever you're doing. Make sure you speak to your financial advisor though before you do anything. That's very important. So I'll catch you at the next video, and whatever you're doing, have fun and play safe. Please read the disclaimer. Remember that prices can go down as well as up.